Now more than ever, investors are searching for investments that can deliver reliable, competitive, and consistent income throughout market cycles. Now, one asset class that is often overlooked is private credit or private debt. The private debt refers to really the loans that are provided by private lenders other than a bank, and it is primarily used to finance commercial real estate. So commercial real estate private debt funds just do that. To know more about whether private debt fund fit your investment strategy, stay tuned. So what is a real estate private debt fund? A real estate private debt fund really consists of private equity-backed capital that lends money to prospective real estate buyers or current owners of real estate assets. So the private debt fund really helps connect the borrowers with short-term capital for certain commercial projects like multifamily, office spaces, shopping centers, construction loans, etc. Now, how do these real estate private debt funds really work? These funds typically have a fund manager or a GP or a general partner who allocates the capital raised from their limited partners to a portfolio of loans. Now, the art of a good private debt fund manager is to choose the right projects to lend to and which ones to ignore. So these underlying loans really pay the interest and the fees to the fund, which gets passed on to the limited partners or the passive investors as monthly cash distributions. Now, what are some of the advantages of investing in a real estate private debt fund? Number one, unique product. Now, debt funds can offer commercial real estate borrowers loans and terms that traditional lenders like a bank cannot or will not offer. So they work with borrowers who have complex financial situations or just do not have access to conventional credit for whatever reason. These borrowers prefer private credit or debts over a bank loan because they have shorter approval process. They are much more flexible and, of course, great alternative to bank loans simply because a bank may not be able to offer this type of a loan in many cases. Now, private debt funds are usually used by borrowers to fund some of the non-conventional needs, which are very difficult for a conventional bank to underwrite. For example, acquiring properties, rehabilitation, construction, refinancing, ground-up development, or even bridge capital. Number two, higher returns. Now, most of the banks are not able to underwrite such type of loans, so private credit lenders tend to charge a tad bit higher interest rate than the bank because they can. Private debt funds have the expertise and the resources to do all the due diligence on the asset type as compared to a traditional bank. This helps them to offset their risk. Number three, security. Such loans are usually secured by a registered first mortgage over the borrower's real property. So if a borrower cannot meet loan repayments, the lender has the right to sell the asset and repay the loan in full. This is because the first mortgage ranks above all other lenders, such as mezzanine loans or equity and so on. So as an investor of a first mortgage private debt fund, you will get paid first if the asset needs to be sold. Number four, consistency. Now, because the loan interest and the fees are agreed upon upfront, a private debt fund can distribute a predictable income stream to their investors. Number five, short hold time. Now, commercial real estate debt investments are associated with real estate development projects, meaning that the loan should be paid in full as soon as the project is completed. In most of the cases, the hold period for a real estate debt investment is 6 months to a few years. Number six, defaults. The greatest upside lies in taking possession of properties that collateralize defaulted loans. Methods of increasing value really differs, but may include stabilization, improving, or otherwise completing a property with the goal of achieving the highest disposition price in the shortest amount of time. Now, let's look into some of the challenges of investing in these debt funds. Number one, capped returns. Now, because your returns are based on a set interest rate, your returns are going to be limited, unlike an equity investment in which you have unlimited earning potential. Number two, risk of prepayment. Now, if the loan is paid off early, your cash flow might be interrupted. Now, liquidity is never a bad thing for most of the investment, so this could actually be also viewed as a positive trait in some cases. Number three, possibility of inflation compromising real returns over time. Now, of course, depending on the inflation rate during the time of your investment, it is possible that inflation can actually cut into your returns. Number four, control. Now, of course, as a passive investor, your role is of a silent partner who provides capital. Now, most debt funds are focused on a particular loan strategy or an investment idea. So you as a passive investor will have to base your decision whether to invest or not in a fund on their advertised strategy, the track record of the fund managers, and their performance history. So you do not really have any control or say over the day-to-day operations or the decisions on how the capital is deployed. Number five, liquidity. Now, most of the private debt funds are long-term investment and they are longer commitments, so they are most likely illiquid funds, unlike REITs or stocks, so you cannot just buy and sell them anytime you want on public market. Number six, access. Now, access is another challenge when it comes to some of the smaller investors or new investors. Many funds have a certain criteria to vet their investors, and that could be based off of their income, it could be based off of their net worth. So this criteria is what they use in order to decide whether they can accept someone as a limited partner in their fund. So there's also certain minimum investment amounts that are required, which sometimes could be higher, 5 digits to 6 digits, and this could deter a lot of new investors and small investors who want to invest smaller amounts. Now, that being said, I also want to point out that there are a lot of passive investors that do private lending on a deal-by-deal basis. Now, this is actually a great way to get started in the private lending aspect on a smaller scale, although even though it kind of is a passive investment, a lot of the times on individual level, you have to put in a lot of active work in order to seek out these deals to lend on. And of course, it restricts scalability and diversification in terms of project that you can get involved in, as compared to professionally run funds which have a lot of resources and capital to do their due diligence, and they can offer a gamut of deals to their limited partners. Watch out for my next series of videos explaining different ways of investing in real estate in detail.